You see it every day, right? It's that single number that flashes across your TV or your phone, telling you if the market's having a good day or a bad one. But what is the S&P 500, really? Well, today we're going to deconstruct this thing piece by piece to figure out what's actually under the hood. I mean, we all hear about it constantly, but what is it? Is it just a scorecard for Wall Street, a random list of 500 big companies? Or is it something way more important, like a mirror reflecting the entire US economy? That's the question we're going to answer. You know, the simplest way to think about it is exactly like this. It's a report card. But instead of grades for one student, it's grading the performance of the largest, most influential public companies in America. Its ups and downs tell a huge story about how healthy corporate America is, what investors are feeling, and honestly, where the whole economy might be headed. And just how big of a story does it tell? How about 80%? Yeah, the companies in this one index make up a whopping 80% of the entire US stock market's value. So when the S&P 500 makes a big move, it's not just a little tremor, it's like the whole ground is shifting beneath our feet. So with that kind of scale in mind, we've got to build a solid foundation. Let's get down to basics and define exactly what the S&P 500 is. Okay, so here's the textbook definition. It's essentially a carefully selected list of about 500 of the biggest and most important companies in the US. So whenever you hear on the news that the market went up or down, 9 times out of 10, they are talking about the S&P 500. It's the ultimate yardstick that everyone measures against. And this thing didn't just pop up yesterday. Its roots go all the way back to 1923, but it really became the index we know today back in 1957 when it grew to 500 companies. That long history, that consistency, that's a huge reason why it's so trusted now as the go-to benchmark for the entire US market. So, how does a company actually get into this exclusive club? It's not as simple as you might think. Let's go under the hood and check out the rules that shape this incredibly powerful index. This quote just nails it, doesn't it? It's not just about being one of the 500 biggest companies out there. There are some really strict criteria. It's like there's a velvet rope, and it makes sure that only the most stable, significant, and financially healthy companies actually get in. So there are 3 main hurdles to clear. First, size. You've got to be a giant. Second is liquidity, meaning people have to be able to buy and sell your stock easily. But this third one, this is the real gatekeeper. You have to be profitable. You actually have to be making money consistently. This is such a crucial filter because it weeds out those big, flashy companies that might not be financially stable. All right, so a company passes the tests and gets in. Now what? Does every company in the club have the same amount of say? No way. And how their influence is measured is probably the single most important thing to understand about how the S&P 500 actually works. See, the S&P 500 uses what's called market cap weighting. It sounds complicated, but it's pretty simple. The bigger your company's total value, the more you move the needle on the index. This is totally different from an older index like the Dow, where a company with a high stock price gets more influence, even if it's a smaller company overall. The S&P's method gives a much truer picture of a company's real economic muscle. And this weighting method creates this really powerful feedback loop. As the biggest companies do well and get even bigger, their influence on the index grows, which helps pull the whole index up with them. It amplifies the winners. But, and this is a big but, it also creates a major vulnerability: concentration risk. The fate of the entire market can get tied to the performance of just a handful of giant companies at the very top. So this whole idea of a few giants steering the ship brings up a bigger question. Why should anyone who's not on Wall Street even care about this stuff? Because this index, its influence goes way, way beyond just a stock ticker. People who make policy, economists, they watch the S&P 500 like a hawk because it's seen as a leading economic indicator. Think about it. Stock prices aren't about what a company earned yesterday. They're about what millions of investors think a company is going to earn in the future. And because of that, the index's movements can often tell us where the broader economy might be headed 6 to 12 months from now. In fact, it's an official ingredient in the main forecasting tool that economists use to predict recessions and booms. Historically, when the S&P 500 moves, the nation's GDP tends to follow. That makes it a vital bellwether for the health of the entire US economy. And this is why it has become the gold standard for professionals. You look at the Dow, it's only 30 companies. You look at the NASDAQ, and it's heavily focused on tech. But the S&P 500, it gives you the broadest, most balanced view of what's happening across the entire large company landscape in the US.
So what does this all mean for you, for anyone who has a retirement account, a 401k, any kind of investment portfolio? Well, it's a story of some really powerful returns, but those returns come with a price of admission.
Let's just start with the headline number. Since 1957, the S&P 500 has delivered an average annual return of about 10%. That kind of powerful, long-term growth is exactly why it's seen as a cornerstone for building wealth over time. But, and you knew there was a but coming, right? That return is not a smooth, straight line pointing up. It doesn't come for free. It comes with a cost. And that cost is volatility. You just don't get the long-term reward without being willing to endure the short-term turbulence. And how much turbulence are we talking about? Well, on average, the S&P 500 has a drop of nearly 14% at some point within each and every year. These dips, these drawdowns, they aren't mistakes. They're a normal, expected feature of the market. They are the price of admission.
And a major source of that risk comes right back to this: concentration. Because of that market cap weighting we talked about, the top 10 companies can have this huge, disproportionate impact on what the index does every day. If just a few of those giants have a bad day, they can pull the whole market down with them, even if the other 490 companies are doing just fine.
The key thing to burn into your memory is this: you have to be willing to stomach the volatility if you want to capture the long-term growth. Those bumps in the road, they aren't a sign that the engine is broken. They're just part of the journey.
Which leaves us with a final and I think fascinating question. The very thing that drives the S&P 500's success, the fact that it bets more and more on its biggest winners, is the exact same thing that creates its biggest risk. Is that a flaw in the system? Or is that simply the price of accurately mirroring an economy that really is dominated by a few giants? It's something to think about. Thanks for joining this explainer.